I had a client that I was talking to a couple days ago, and they were discussing a 5-5 ARM. And I know we haven't talked about ARM, so can you go into a little bit of detail about what an ARM is and what the numbers actually mean for that?
Right. Yeah. So the ARM, typically people looking at ARMs comparing to 30-year fixed is because they might have a little bit lower interest rate comparing to the fixed rate option. So I actually have a little PowerPoint presentation that I can share with you. So, it's always better to kind of like visualize things and see what ARM, what that is. Let me try to share. I think we'll have to kind of cut a little bit here.
Yeah.
Because I'm gonna do this and then I'm gonna do this.
I love that you do this, Tatiana, because it's so much easier for people to really wrap their heads around this stuff rather than just hearing all the words all the time and it's still not making any sense. This is great.
Exactly. And I'm more also visual person, and it's just makes it much easier. And I like this Zoom thing because it allows us to do this little presentation. It looks really good. Okay, so ARM stands not for ARM, it stands for adjustable rate mortgage.
Okay.
So rate adjust. There are different options: 5-1, 7-1, 10-1, 5-6 months, 7-1, 5-5, like you mentioned, 15-15. So what that is, 5 stands for the period, locked period, 5 years. The interest rate is going to be locked for 5 years. 1 stands for how many times it's going to adjust annually. So it's locked for 5 years and then it adjusts once a year. 7-1, obviously locked for 7 years and adjust for every year after that. This 10-year. 5-6 months means that it's fixed for 5 years and then adjust every 6 months. 5-5, fixed for 5 years, adjust every 5 years. And there's also 15-15 option. Basically, loan is amortized over 30 years, but the rate is fixed for 15 years, and then it adjusts once and stays like that for another 15 years.
Okay, so the second number is not how many times per year it adjusts. The second number is the frequency of when it adjusts. So if it's 6 months, it would be every 6 months. So that'd be twice a year. If it's 5-5, that would be it adjusts every 5 years.
Every 5 years, exactly.
Okay,
right.
Got it. Okay.
So I guess 1 would be for a year, right? So once 1 a year and then 6 months, yes, like that.
Gotcha.
So then what else? How does it work? So the ARMs also have caps. So when you have initial rate, what happens after adjustment period comes, right? How does rate adjust after that? So they have caps, and we have right here, you can see 2-1-5 or 5-1-5. It means that the first number shows how many points, how many percent it can adjust the first adjustment period. Second number, how many points it can adjust after that. And the last number, it's a lifetime cap. Basically, for example, the first adjustment year, let's say we had 5-year, 5-1 ARM, right? And the rate was fixed for 5 years at 5%. And then the very first year, it could go up by 2%. Basically, the first adjustment year 6, it could get to 7%, right? After that, it can, and actually it could go up or down. It fluctuates up or down. The second part, the middle, is how it adjusts after that every year. Once a year, it adjusts not more than 1%. So it could go to 8%. Or it could go to 6%. So but it goes only by 1% up or down. And the last portion is a lifetime cap. So it means that this rate cannot increase by more than 5% of initial rate. So if the initial rate is 5%, over the life of the loan, the highest it could get is 10%. 5 plus 5 is
So even if, God forbid, the interest rates went back the way they were in the early 2000s,
Or
like
the
what,
80s,
12,
yeah.
14, yeah, it could never go above 10%. So if everybody
Exactly.
else is getting 12%, you're locked in at the 10
Right.
in that
That's
example. Okay.
Yeah, and it's very important for those who are looking into ARMs to see what the lifetime cap is. They don't want to be capped at 25%, right? Or
Right,
something
right.
like that.
Okay.
So then how it's calculated when that adjustment period comes. How do we know if it adjusts by 2% or 1 or half? It gets a little bit more complex at that point. I'll try to explain as best as I can, as
Okay.
simple. There is always a margin, and margin never changes. And that margin always is disclosed at, at the initial application, what that margin is. And it's, for us, for example, it's 2.75%. The
Okay.
margin is 2.75%. And then when that adjustment period comes, we'll look at index. And again, you need to know what index your ARM product is attached to. It could be LIBOR. LIBOR is London Interbank Offer Rate. It stands for that. It could be 1-year treasury bill, and you can actually Google it and see what's LIBOR rate today.
Right.
And I just actually Googled it and I looked, and here's the number. So let's say initial rate is 7%, which is more realistic than 5 that they gave before. Margin 2.75%. Let's say my rate is about to adjust and I want to know how high it's going to go. Of course, bank will send you information about it, but you want to be prepared. You want to have an idea. Then you look at today's LIBOR, which is 5.42%. You combine margin plus LIBOR and you get 8.17%. That would be your new rate. And if we remember, the first adjustment period cap was, in this instance, like let's say it's 5%, it's 2%. So 7 plus 2 would be 9, but we are at 8.17%. That actually will be our interest rate.
Okay.
Okay.
Okay. That makes sense. So let's say, for example, the index, instead of being 5.42, had jumped to 8, and then we added your margin. Well, that would have gone beyond that 2 percentage point max. So it would just go down to the max, which would be 9% in this instance, right?
You got it. Exactly.
Woo-hoo.
Yes.
Good job.
Very smart, Kelly.
So, okay, so now let's go the other way. Let's say that the interest rate drops to 4%. And it's in that window where it's now adjustable. But you're saying that too, the adjustable amount is up or down. So if the interest rate dropped to 4%, then the new interest rate
Will
would
be
basically,
5.
it would
Only
be
go
5.
to 5.
I got it. Okay.
Okay.
All right.
Good. So it's on both sides, both into the spectrum are
Protected.
Right.
protected.
Yeah, so it could go up or down.
Okay.
And going back to why there are 2 different options of 215 or 515, it depends on the ARM. Typically 5-1 ARM or 5-year ARM, it goes by 215 ratio.
Okay.
And if it's 7 and 10-year ARMs, they go by 515.
Okay, because they
So
want
the
to have
very
more
first year
flexibility the longer the time.
Exactly. Yeah. So the very first year with 7-1 ARM, it could go all the way up to the maximum lifetime cap.
Right.
Okay.
Right.
Is it true that generally speaking, the smaller the first number, so a 5-1 ARM would generally speaking have a lower interest rate than say a 10-1 ARM? Is that right? Because you're locking it in for a shorter amount of time?
Right. Yes. And in this market, actually, it's funny sometimes 5-year ARM is worse than 7 or 10. And that's, you want to ask your loan officer, what are the rates on all of these ARMs?
Okay.
And then it's no brainer. If 10-year ARM rate is better than 5, you just go with
Right, exactly.
that.
Okay.
And you
And this
always
is-
can refinance. There's no prepayment penalties too.
Oh, good. I was
Okay.
gonna ask that question
Yeah.
about if you were locked out of refinancing
Mm.
for any kind of time frame.
No, the traditional loans, they don't have any prepayment penalties, but you also always want to double check on that, of course.
Okay.
Okay.
All right, and I have a question about the indexes you mentioned. Can that change throughout the life of the loan, or whatever? Is it disclosed initially and it's always going to be that index that's used?
The margin is always the same.
Okay.
The margin is always the same. It's typically 2.75%. It could vary slightly,
Mhm.
but it typically at this level, 2.75%. The index is the one that changes all the time.
But what I'm asking is where the index is pulled from. Can that change?
Can
Like,
it switch from LIBOR to Treasury?
Oh, gotcha. No.
Okay.
If you're getting ARM with LIBOR index, you're gonna always stay with that. Or
Okay.
with 1-year treasury, unless something happens within, and then you're gonna get notification that they switched you from one another. But as far as I know, you stay with the same.
So if somebody chooses an ARM, because we talked last time about discount points, and there's obviously an added cost. So you run your return on investment based on when the break-even date is and so on. But with regards to an ARM, is there any additional fee if they choose to go with an ARM, or is it just calculating their estimated risk of when the rates are going to change?
Yeah, there is no additional fee for that. It's basically the risk, and some people don't like to have ARM just because they don't like an idea that at some point my rate is gonna change.
Right.
Mhm.
And the ARMs are not for everyone, but if you know that you might not be in property for more than 5-7 years, you want to go with, if you're thinking between 5 and 7, go maybe with 7 or 10, right? So
Right.
you have that cushion in there.
Right.
A lot of people think that we're gonna have some rates drop and rates are gonna go down.
Yeah.
It might happen. It will happen when, we don't know.
Yeah.
Some people are okay taking that risk, and we're gonna take low rate right now and we're gonna refinance anyways.
Yeah.
So it's
Yeah.
just very individual and
Depending on your
customary for
goals.
everyone. Yeah.
Okay.
So I bet you're doing a lot more ARMs these days than you were this time.
I'm doing some ARMs. People are still, a little bit conservative, and not everybody does them, but some
Yeah.
people, if it makes sense, it makes sense. Yeah.
Right.
Yeah. Okay. Yeah, because the ARMs got a really bad reputation, if I remember correctly, back in 2007-8, because that's what everybody had. And
Exactly.
and then they got into the situation of the refinance, and they didn't have any equity, so then they were upside down. They couldn't refinance,
Yeah.
stuck with high interest rates, and lost the house.
But
So
a reminder, let's say this to everyone. We say that cannot happen again in this real estate climate. There are things in place. We're not having a repeat of what happened back in the early 2000s.
yeah, we don't have a new crash.
It was just completely different times, and the mortgage industry was so unregulated.
Yeah.
That's
And
why all that happened. And
there
now
weren't those like interest only ARMs back then, so the payments were really low. And then when the ARM ended, all of a sudden they had the principal plus interest, and the payment was gonna go up automatically. And that's why they had to refinance, but then they couldn't, so they got in trouble.
Right.
I was in that situation when I bought back in 2006, right before the crash. I got 7/1 ARM interest only.
Yeah.
Yeah.
And that's how you could get into the house, right?
Yeah.
Right.
Yeah.
To have interest only. And of course, my husband was we
That's
need to
what they do.
refinance. We need to refinance. And of course, everything crashed. We were upside down. But then Obama came up with that refinance program where you could refinance even if you're upside down. So we were actually doing a lot of those. And I was able to refinance into 30-year fixed, thinking, never again. But now it's different. If I'm buying something and I know that I'm not going to be there for 30 years, or maybe, I'm confident that I will be able to refinance in 5-7 years, I would be okay with 10-year ARM, and it's fully
Right.
amortized. You know, interest.
That was the key. That was the
Right.
key, is there was no principal payment being made towards the house with those interest-only ARMs.
Yeah.
So you were
Exactly,
just paying interest.
and you always can pay extra, of course,
Right.
but not everybody organized enough to do that.
Right,
So
right,
if
right.
you have fully amortized, you have no choice, right? You just paying and paying down the principal. If you have interest only, you feel like, oh yeah, I can pay more to principal, but
Yeah,
I would rather go on vacation or spend that money
Right.
somewhere
That's
else.
it,
So
right.
you just need to be very organized.
so there are interest-only ARMs now? Those are available?
There are some like more in portfolio products, non-traditional, that
Yeah.
it doesn't work in normal situation.
Yeah, got it. Okay, that's what I was thinking, that those weren't really available.
And I
So,
think another one of the big factors that contributed to the downfall back then wasn't just that they had the interest only, but they didn't verify people's income
Yeah.
back then the way they do now. Is it right?
Absolutely. Mhm.
Yeah. Yeah.
and we're kind of digging into this a little bit for the differences, because ARMs are kind of associated with that time.
Yeah.
And a lot of buyers are sitting on the sideline right now because they think that 2007 is about to happen again. And we just did a long last week's market report. We went through all the statistics
Yeah.
showing how that's not going to happen. So we just want to be very clear that an
Right.
ARM is a good tool. It is a good option. It's not
Yeah.
the ARMs of yesteryear.
Yes, it's not a
It's not
red
the
flag
market of
anymore. And the property values now, we're maintaining that equity in
Yep.
the houses. You know, we're not losing, like you said, it's like, wow, we're upside down. That's just not happening.
Yeah, yeah.
Yeah.
Okay, great. So I think that's covered pretty much everything. So how can people reach out to you if they have any questions about this, or if they want to talk to you about mortgage options?
I'm always available at my phone. Very easy to remember, 571-245-3000.
All right, awesome.
Very
Thank
good.
you so
Thank
much.
you, Tatiana.
Thank you,
Thanks.
guys.
We'll see you next week.
Bye.
Bye.
Bye.